Let's now come to one, let's say, larger learning goal that we have to tackle when we look at the income statement. It's calculating depreciation based on two separate methods, the straight line and the reducing balance method. And as I told you before, depreciation is the loss value of a non-current asset. So if your phone or your computer or your car is losing value from 1 year to year, this is called depreciation. There's also something called amortization, which basically means that a non-physical non-current asset loses value. So if we have a patent or something like that, then this might also, let's say, expire over time or reduce value over time, because it might run out after a couple of years. But then it's called amortization, and depreciation is only for the physical non-current objects, assets. So all the tangible non-current assets depreciate, all the non-current intangible assets amortize. Let's look into straight line method and depreciation in itself. So as I told you, now there's a little bit of repetition. The definition is that most non-current assets do not exist forever. They have limited lives, because also your phone that you had 10 years ago, you probably don't use that anymore. So this basically means non-current assets lose value and they can't be used at a certain point anymore, or you don't want to use them anymore, and so there is a time when you change the asset, and where basically you can't get the same amount of money as you paid for it. Because if you buy a car for 30,000 euros today, in 20 years, unless it's a designer car and it might, let's say, increase in value, normally your car might still be worth like 3,000 euros or 2,000 euros, so there is a loss in value. That's what depreciation is all about. So non-current assets get used up while generating the revenue. So if you have a truck that you use for going to customers, delivering your products, this truck will actually depreciate. So it will actually lose value over time. Things might break down. The car loses value, or the transportation vehicle loses value over time. That's called depreciation. So the total depreciation on an asset is also called accumulated depreciation. It's also just another word for total depreciation. And of course, that's the depreciation that, let's say, your phone collected over the last years that you used it. So of course, therefore, you have a yearly depreciation and a total one where all the yearly ones are summarized. And if we now look at what you paid for the asset, let's say we paid 30,000 for a car. Let's say after 10 years or 20 years, the depreciation is 27,000. Then it's still worth 3,000. And this, what it's still worth today, is called net book value. That's important. Please remember, net book value is what the asset is still worth today after all the depreciation is subtracted from the original price or cost of the asset. Okay? So net book value. For intangible assets, like I told you before, we use amortization instead of depreciation. So patents, for example, copyrights or something like that, amortize but don't depreciate. If we now look further at the calculation, as I told you, you have two methods, and basically for those two methods you need a couple of elements. The first thing is we need to know the cost or the fair value of the asset. So if you bought the car for 30,000, then this is the cost of the asset. So we need to know that. Then we need to know the useful life of the asset. Of course, there are also certain documents online that companies use to determine how long usually a car, computers, and so on can be used. So there you can also then check the certain requirements for the different types of assets. So how long is the useful life? Meaning basically how long can you use a certain asset, 10 years, 5 years, 15 years, and so on. Then the residual value of the asset, meaning if you use the asset for a certain amount of years, how much is still there at the end of the life of the asset. Because let's say after 30 years, you can't drive a certain car anymore, but you might still be able to sell it for 1,000 euros because somebody needs the different parts of the car. So that's the residual value of the asset. So what is left at the end of the life of the asset. And then we have to choose between different depreciation methods. I'm going to explain to you two of them. There are, if you look online, you might find others, but we will focus on the straight line and the reducing balance method. So let's start with the straight line method. Straight line is the easiest, or let's say a very easy form to calculate depreciation. It simply means we have an equal depreciation every single year. And the formula for this is also not too difficult. It simply says the yearly depreciation or the annual depreciation is what we paid for the asset, so the cost of the asset, minus what the asset is worth at the end of its life, divided by the amount of years that we can use the asset, so the useful life of the asset. And with this, we then find out what the yearly depreciation expense actually is. So it basically, if you look at the net book value, so what we just learned, net book value, let's say we start here, it goes down equally until, let's say the useful life is only 4 years, we still have, let's say, 1,000 or 2,000 left as the residual value of the asset. If we calculate this, let's say we do a little task, we say we bought a machine for £78,124. We can say that after 4 years, the machine can still be sold for £2,000, and we can estimate to use the machine for 4 years. So please put that in the formula and try to calculate the depreciation. Because if we do that now, we can see that 78,124 minus the 2,000 divided by 4 years gives us a yearly depreciation of 19,031. So that's the depreciation that happens every single year until the asset is at the end of its life. If we now try to figure out what happens in the balance sheet and the income statement, we actually see different things that we have to consider. So let's assume that we as a company bought a machine at the end of December 2015, and now it's 2 years later, just as a time period. 2 years ago we bought the machine, and now actually we have to look at the machine or at the components in the balance sheet and income statement. So let's first of all look into the income statement for the year ended 31st of December 17, and there we already have the machine for 2 consecutive years. So basically, the annual depreciation of 19,031, which you also just calculated on the last slide, is shown as an operating expense. So as a kind of day-to-day, or let's say daily business expense. And not the double amount is shown because we just look at the income statement for one particular year. And so only one depreciation, of course, then is relevant. It's not the total depreciation, but just the yearly one. If you look at the balance sheet, at the same point in time, so 2 years after we bought the asset, we can say that we bought the asset for 78,124, and we have 2 years of depreciation. After 2 years, it has depreciated 2 times this amount. So 38,062. So what is still left? The net book value is 40,062. Simply this minus this gives this. So cost minus the total depreciation gives this. And basically, if you look at the real balance sheets of companies, sometimes they just don't show this, but they directly show what the machine is still worth. And there's also in the homework task that we have, what basically you're going to find that they don't use these two, but they directly show how much the asset is still worth. And we can see we have 2 times depreciation. We have an annual one. The annual one is always to be found in the income statement. And we have a total one, accumulated one, which you might be able to find in the balance sheet if the companies decide to disclose this information separately. Let us now come to the next depreciation method, which is called the reducing balance method. And here, this is a little bit more difficult to calculate. It basically says that there is a fixed percentage rate of depreciation, which is always related to the net book value of each year. So basically this means that every year we have a look at how much is the asset still worth, and then we multiply it with a certain percentage to know what the depreciation for that particular year is. It looks like this, that at the beginning you have a higher depreciation and this slows down at the end. I'm also going to explain to you at the end of the slideshow how you decide which depreciation method you use. But for now, let's focus on the calculation. And now it comes, the formula looks a little bit tricky, a little bit difficult, but let's have a look at this together and try to understand the different components. It actually says, and here's the description, the percentage, because sometimes you have the fixed percentage given, and sometimes you do not have it given. And of course, if you don't have it given, we have to calculate this. The percentage of depreciation equals, open bracket, 1 minus, and then we have the n root, and n is the useful life of the asset in years. So we simply take the years, amount of years, put this in front of the root, so let's see, fourth root, fifth root, or something like that, and then we have the residual value divided by the cost, and multiply with 100 to get to the percentage. So please have a look at how to put this in your calculator. Some calculators are a little bit difficult to operate in this sense, but just important is that you basically type in it's a fourth and then the root of the residual value over the cost of the asset. Let's take an example. Let's have an example of that. Let's assume that we have the same calculation, the same task. Basically, we have still 78,124 as the cost of the asset. We have a residual value and 4 years. So please also try that at home. Try to put in the different components into your calculator, and then we see what the result is. So we start with 1 minus, or open bracket before, the fourth root, because we have 4 years. So simply set 4 and the root. As I said, if you have any issues with your calculator, the version that you use, please approach me and let me know what your exact questions are. But usually if you use a Casio FX82MS, basically what you have to do is simply type 1 minus and then just put a 4 in there. And then you find that there, if you click on Shift, that there is a root sign. And I'll just show that to you here how it looks. It looks like this. So basically what you have to do is put a 4 and then this to put it in the calculator. But that just, of course, works with this type of calculator. So this would be the way to put it in this calculator here. And then you have the residual value over the cost. Residual value is the 2,000 divided by the cost, which is 78,124. And with this, if we then multiply the whole thing with 100, we get to 59.999872. And so what we can say, if we round this up, that we have a depreciation percentage of 60%. And so with this, we already basically covered the difficult step of calculating this. So please try this at home and please have a look at if it works for you with your calculator as well. So with the cost of the machine of 78,122, and if you want to know now what the depreciation in year 1 is, we simply take 60% of this. So year 1 depreciation is 60% of this, and this would be 46,874. Net book value is simply this minus this, is giving us 31,250. So that's all year 1. And as I told you, for year 2, we have to do the process again. So it's an iterative process, basically. 31,250 multiplied with 60% gives us 18,750. So you see, it reduces. The depreciation per year is reducing the longer we have the asset. So 31,250 minus this gives us what the asset is worth at the end of year 2. And then we go on. For year 3, we also take, again, 60% of the net book value, so 7,500. So if we take this, multiply it with 60% again, we get to 7,500. This minus this gives us 5,000. And we do it again, 5,000 multiplied with 60% gives us 3,000. And 5,000 minus 3,000 gives us 2,000, which is the residual value. And now we know how much depreciation is charged to the income statement at each year of the asset's ownership. So that's the example. Let's do the same thing as we did before. Have a look at the balance sheet and income statement. Let's say again we bought the machine in 2015. Now it's 2017. So it's exactly 2 years of a difference. So 2 years of depreciation. Again, if we now look at the income statement for the year ended 31st of December 2017, question 2 is, which annual depreciation do we have, or which annual depreciation does the company need to put on its income statement? And so if you look back at the last slide, you can say actually it's this one here. Because basically this was year 1, but we look at year 2. So 18,750 is shown as the operating expense of depreciation in the income statement. But balance sheet looks a little bit different. It's also again exactly after 2 years. And here we had a cost of 78,124, so that stays the same. But you can see here our depreciation is higher than if we would use the straight line method. And why is that? Let's move back to the old slide, or to the other slide. It's depreciation year 1 plus depreciation year 2. And these two together actually provide to us, or give to us, 65,624. Okay, so in this case you see depreciation is higher in the early years and lower in the later years. So if you look at the straight line method, it's equal, but with the reducing balance method, first of all we have more depreciation and then it gets smaller and smaller. So we see after year 2 here we still have 12,500 as a net book value of the asset. So that's how much the asset is worth after 2 years of using it. So how do we now decide which method to use? Basically, the choice of method depends on when the economic benefits of the asset are received. So straight line method is used when the economic benefits are received evenly over time, so when the asset actually provides to you the same economic benefits from year 1 to the end of its life. But if you feel like the asset actually reduces its performance over time, and basically the economic benefits are received, the economic benefits are higher at the beginning and lower at the end, then you would use the reducing balance method. And of course, you can now think of different types of assets that might relate to these categories. There are, as I said before, certain documents that you can also have a look at in the different countries that stipulate which method is used for which type of asset. And there it's then easier for you to understand which, or it's clearer for you to understand which method is actually used. With this, hopefully we answer the question of how to calculate straight line and reducing balance depreciation. Of course, straight line is easier. Reducing balance is also, if you understood it, not too complex. But of course, using the formula might be a little bit difficult, but also knowing what to multiply with what to get to the net book values of each individual year.